Welcome to the deep dive. So, you handed us some really interesting sources this week. They're all kind of grappling with that big question. Where should I invest my money over the next, say, 10 years?
Yeah, it's a huge question people have.
Exactly. And our mission here is basically to pull out the key takeaways from everything you shared, try and give you a clearer picture without, drowning in all the finance speak.
Absolutely. And the material you sent really zooms in on some major global shifts. Things like de-dollarization talk, persistent inflation, tech disruption. It's all in the mix.
Right. So the core question threading through it all is, what's the smart investment play for the next decade, considering all that background noise?
And the sources cover quite a range, don't they?
They really do. We've got real estate, crypto, gold, the classic 401k, and even dipping into overseas investments.
Quite the spread. Where do you think we should start digging in?
Well, maybe the most grounded one first. Real estate comes up quite a bit.
Okay, yeah. The sources frame it as, a tangible thing. You can actually see it, touch it, plus the potential for appreciation, maybe some rental income.
And tax benefits too, right? Leverage was mentioned as well.
Yes, exactly. Leverage can potentially amplify returns, though it also has risk, of course.
Yes.
But it's generally seen as a steady sort of foundational investment.
Especially in growing areas. I think New Jersey was mentioned specifically as an example of a dependable market in the source material.
Right. Now, switching gears quite drastically, there's cryptocurrency.
Ah, yes. High potential, but also high volatility.
That's the word. High highs, potentially low lows. The material seems to suggest treating it cautiously.
Yeah, the recommendation felt like maybe keep it a smaller part of your overall portfolio, like 5%, maybe 10%, for that potential upside.
But probably not for peace of mind. It's more speculative.
Definitely not sleep well at night money for most people, I'd guess. Okay, what about gold?
Gold is positioned very differently, more like a safety net.
Right, something to protect value when things feel uncertain.
Exactly. It doesn't really produce income like rent or dividends. But its appeal tends to go up when people feel nervous about the economy or, instability.
Makes sense. A hedge, basically.
Then we have the 401k. Familiar territory for many.
Yeah, the big pluses highlighted are the tax breaks, obviously, and that employer match, if you can get it.
That match is key. It's essentially an instant return on your investment.
Yeah.
Hard to beat.
True, but there's a catch, isn't there? The flexibility or lack thereof.
That age restriction, 59 and a half. The money's generally locked up until then. Taking it out early usually means penalties.
Which could be a problem if you suddenly need cash in, say, a crisis situation. Not ideal.
Definitely a trade-off there.
Yeah.
Okay, last one on the list was overseas investments.
Right. Potential benefits there, maybe higher growth in some markets. But it sounds complicated.
Very. The sources flag increased risks, currency fluctuations, political issues, different rules and regulations.
Yeah, the advice seemed pretty clear. Tread carefully unless you really know the local scene or have solid connections on the ground.
So, kind of pulling it all together, the material suggests a blended approach, doesn't it?
It does. Like, use real estate for a foundation, maybe sprinkle in some crypto for growth, have gold for protection, leverage the 401k for taxes.
And be super cautious and informed about anything overseas. It paints a picture of diversification.
And it's interesting, the sources bring in Anil Agarwal's perspective. His experience is highlighted as important context.
Yeah, having lived through, 3 recessions? That gives weight to the advice. He's seen how things can play out.
They even gave that specific example, the 2012 cotton price spike, how it hammered the clothing industry. Aeropostale losing its stock listing was mentioned.
Wow, yeah. That kind of real-world consequence really drives home the point about market volatility and needing a strategy that considers those risks.
Definitely grounds the advice. It's not just theory.
So the overall message from the sources seems to be, don't put all your eggs in one basket for the next decade. Balance stability, growth potential, protection, and tax efficiency.
Which really brings it back to the listener, doesn't it? The question becomes, how do these different pieces, real estate stability, crypto's potential pop, gold's safety net, the 401k structure, overseas complexities fit your specific situation?
Your risk tolerance, your long-term goals.
Right. And maybe thinking about those past examples, like the cotton crisis, how does that make you think about navigating the uncertainties we see today? Definitely gives you something to chew on.